Good morning, ladies and gentlemen. This is Clueless 8. First pre-market AM report for January 4th, 2016. In the Chinese zodiac calendar is the year of the red monkey. And please Google it and see what all that means. That is exactly how the year is starting out with the Chinese markets. I want to wish everyone a very warm and successful and profitable 2016. And I look forward to working with every single Clueless 8 trading member and all the others who will join our group this in the upcoming days and months. Let me go straight into the markets. We had a phenomenal meltdown in the Chinese markets. I was actually hoping that they would hit the 8 number, but it looks like they capped it around 7% decline before the triggers, the stops. What do you call it? The market triggers were implemented, and the market was halted. Now, saying all that, let's one of the key themes of 2016, in my opinion, as a trader, as an investor, is to be as informed as possible. I've always said that knowledge is power. I've shown that repeatedly in understanding the nuances and that real story behind what actually goes on, and not rely on the media and other forums, investor forums, emotional rants by traders and investors. I don't think they do anything for anyone. The real reasons behind this sell-off are important and should be understood. I'll keep them brief. Number one, China implemented capital controls where very large, foreign institutional money management firms, hedge funds, and banks, and I believe that they did that with 2 of them, and sanctioned a few others, and put in a clamp where they couldn't take money out of the Chinese markets, or they couldn't take money out of China. Capital control is a very dangerous word. It reminds people of what happened in Greece. It reminds people on every single major crisis in emerging markets, and China is certainly an emerging market, where if the authorities and the regulators and the government clamps down and puts down rules where you can't move, where global capital cannot freely move in and out, then obviously that is a very dangerous precedent. So that's one reason. The Chinese manufacturing, the private manufacturing data that came out that showed a little bit of a slowdown. Well, we already know that. That's already discounted for in the markets. Nobody's expecting a blockbuster growth on the Chinese economy immediately with all the stuff that they're doing. We have some major tensions, which we know, between Iran and Saudi Arabia, 2 major global powers in the Middle East, and that's obviously nerving markets a lot. Now, saying all that, you're not seeing oil spike up $4 or $5. Very interesting, right? Oil is only up about 40 to 50 cents. You'd expect oil to be up $2 or so if a full-fledged firefight breaks out between these 2 geopolitical regional rivals, which we know. Saudi Arabia can't stand Iran, and the Iranian mullahs can't stand the Saudi clerics. All right? And then Saudi Arabia went ahead and did executed not an Iranian, but a Shia mullah, imam, I should say, out there in Saudi Arabia. So that inflamed tensions, and in Iran, they burned down the embassy, the Saudi embassy, and all that stuff. So there you go. All right. The other interesting thing that I've been noticing since last night is the dollar. Normally during, as I've explained very clearly many times before, during times of major global crises, as we're going through right now, the perfect storm. Oh, before I forget, the other part was Hillary Clinton is very adamant about raising taxes on the higher end of the income range, what she calls the super wealthy, and that's I think that has a little bit to do with it too. Given the fact that she's going to lay out her proposals on what she wants to do with tax hikes. Wall Street and markets don't like tax hikes, and especially when prominent presidential candidate goes out there and starts talking about it. We know what she did when she talked about drug pricing and all that stuff. It caused a nice corrective pullback on the biotech index, which itself was a buying opportunity, but still. Now, the other thing that I'm noticing is that the dollar, the US dollar. Now, I'm going to show that very quickly on the background, and you'll notice that the dollar is not spiking to any very large degree. Yes, it's starting to creep up, but if you look at the dollar here, let's say on the 1 hour charts, which is the best way to look at it, we're just starting to see a move up on the dollar. I would expect the dollar to be breaching 100 or at least over this line here at around 99 on this type of geopolitical strife. After all, anytime that there is any global conflict or global crises, money pours into the U.S. Treasury markets, pushes down U.S. Treasury yields, raises U.S. Treasury prices. That's government bonds because, after all, they are the riskless asset, the only riskless asset that's out there, as in parking money, safe haven buying, as they call it, flight to safety, you name it. So the bottom line is, in order to do that, it pushes up the dollar and all kinds of good stuff. And if you look at it, the dollar is just, it's starting to move up. You can see that happen right now as we speak. But we're not seeing any major spikes. So that's also telling you something. I was expecting the dollar to be significantly higher, up in the 100 range, because that would be the first level of movement as money, as global capital, which moves freely around the globe, parks it in the strongest currency in the world, which is basically the U.S. dollar, as in credibility and strength. It's a global reserve currency, the number one global reserve currency, and in my opinion, will remain that way for many years to come. So a lot of interesting, a lot of stuff going on. There's a perfect storm, as I explained in simple terms. And right now, we're going to take a look at the markets and see what's going on here. So here we have the hourly chart that I've been showing for a while. Now remember, when these black swan events happen, and the Chinese market meltdown is a black swan event, okay? No question about it. It's an unprecedented event because futures were actually up when the markets opened for futures trading around 6 p.m. At 6 p.m. Sunday evening, and then things started to unravel. So the bottom line is, at this point in time, I'll tell you straight out, technicals really don't matter that much. Yes, I certainly will keep an eye on it, but if people are trading off, if they're trading off the stochastics and stuff, they got to do it very quickly. This is not the type of market. I said this, the year of monster volatility. I said that in my end of the week report, which I published last night. And that's exactly what the story is right now. So yes, technicals do matter. Pattern symmetry will come into play, but you cannot lie on your laurels and think that it's a one-way binary trade where you're going to buy something and it's going to be higher, for the next couple of days. It wasn't like that in 2015, and it's not going to be like that in 2016. So please be aware of that. Okay. Now, saying all that, you can see a pattern symmetry develop here. And of course, you got the highs here. Forget that for now. So what you're seeing is this very large formation. And I did say that there is a possibility that this would happen. I didn't say that this was a big possibility because we didn't know China was going to happen like that. But the bottom line is, so you have this very large trading band and some sort of dragon bullish formation, but I'm not going to go into the bullish part yet because there's way too much damage that's been done over what happened overnight, right? So the bottom line is, let's keep things in perspective. The 1980 mark on the E-minis is an important mark, and I think we get there after we bounce a little bit, and that bounce should be capped at around 2010. If we go over the E-minis at 2010, we should be able to move up rather quickly, engage the falling 34-day moving average and the 50-day moving average somewhere around 2040, which is also where the channel, this uptrend channel broke. Right around there, 2035, right? I did say that on Friday that we would, after we started to see that sell-off, and that 2030 would be the mark on the S&P 500s, somewhere around there. And of course, that's ancient history right now. So these are the levels we're going to be watching very closely. This chart that's going to be put out there as a static chart is really a roadmap. So you figure out how you're going to manage the trades in between. I wouldn't suggest just diving in there and buying things, period. I suggest scaling in, We have some selective situations that are in play. Baxalta, BXLT, looks like the deal's going to get done at around $45 to $48 a share. Let's see what happens, okay? And so selective positions, smaller, and of course, once we create some sort of double bottom, very important, a double bottom, okay? Whether it be a slightly higher low or so, or even a move to 1980, that would be the point of what I consider to be aggressive entry on the long side for the next 24 to 48 hours. I do not know if it's going to happen now. We're seeing the McClellan oscillator at minus 246 on the 1 hour chart. That's I'd like to see it at minus 300 or more. The deeper we get into the hole, you're going to see short covering, and that's going to be the trigger to ride the wave quickly for possibly the next 100 to 200 points. Keep in mind that we have lost possibly about 600 points from just within a matter of days since last week, since last Wednesday, right? On the Dow Jones. So yeah, so that's basically it. The channel entry is very bullish. Don't think that's going to happen yet. I think 2010, 2020, and I'm going to show this on what's going to cap the thing. These are volatility clusters, as you can see here. These are the volatility clusters, and that's pretty much what which I think will cap any type of upside move at this point. You got to adapt. That's the key point. So let's take a look at the S&P. The S&P 500, the 1 hour chart, has 1990 as a pretty strong low. And of course, this was from Friday's close. So we're all the way down here somewhere. And let's take a look at so if we stick to the 1 hour chart, the lines are pretty well drawn, okay? You got one level here, you got the 1990 level. If we break the 1990 level, we're gonna go to 1940. Remember, every S&P point is roughly about 6 to 7 Dow points, so you can figure out how much the Dow can go down by. And if you look at this chart here, from the highs of 2134, you can see here that we could very easily go to 1990, which I think where we're going to open at, lower end of the Bollinger. And then you got another level here at 1950, which was this inverted, this was what do you call it? The dragon bullish breakout, if you want to look at it that way, at that level, from this level here, right there. Right there. That was back on October 2nd. So you got 1950. Going back to 1850, 1875, given what's happening out there right now, I think that's a pretty damn good possibility. Is it something that's going to happen just in one day? I don't think so. But if China falls another 7% tomorrow when they open, it was halted for, remember that, then we could see another major move. So whichever the case, stay out of harm's way for now. And look at the daily chart here. This of course is not real time. Let's see how oversold we get. And again, just because you get oversold doesn't mean you're going to bounce. You could stay oversold like we did here for a couple of days before we take off. One way or the other, I think there's a pretty damn good possibility we get a nice fat 200 to 300 point reversal rally over the next 48 hours, if not 72 hours. It all depends on how the market handles what's going on overseas, because this is certainly an overseas situation that's going on. The other thing which I forgot to mention to you is very important is that Stanley Fischer, the vice head chairman of the Federal Reserve, made a comment on his weekend speech which talked about the Federal Reserve willing to raise rates if they see asset bubbles. Now, those are dangerous words. In other words, the Federal Reserve is getting into the game of pricking asset bubbles, in which case the market doesn't know exactly where they think that the Fed thinks the market is overvalued. Of course, when they look at overvaluation stuff, they're looking at the high yield bond market. They're looking at other factors where a lot of speculative money is going in. And of course, we have seen that corrective action too. So that's another thing that unnerved markets. So those are the real reasons why the markets are down to this degree here. And like I said, this is the SPYs, and that was the uptrend line. Looking at the SPYs on a 1 hour basis, this is where we are right now. So 199 is a reasonably good floor, and of course we can lose that in a second on the market as it opens. And then you got the 198.84, and then you got this move here 196.8, and then you got I'm not looking at 1870 right now. I mean 187 on the thing. Thank you for listening. Have a great day.